Good evening, everyone. Good evening. A big warm welcome to all of you. Thank you so much for joining me. My name is Adam from Trade with Precision. Please, can I do a quick check? I'm using a different headset this evening. Can you just tell me if you can hear me, if the sound is okay? Just give me some feedback. Seems fine on my side, but I'm a little worried that that you're not hearing me. There we go. So let me know if the sound is good. So my name is Adam Harris, as I said, and tonight's topic is the crypto market movements. Is this a bounce or a trap? So nobody has responded. There we go. Thank you very much, Syed. Thank you so much. I was a little bit worried there. I've switched headsets and it's, yeah, so I just needed to check. Thank you. Cool. So the topic, as I said, is crypto market movements. Is it a bounce or a trap? So we are going to do some live market analysis. I would love for this to be as interactive as possible. So if you have any questions, please don't be shy. No judgment. I'm open to any questions, whether you are a new or seasoned trader, either way. And I want to do some general market analysis. And if there's anything else specifically that you would like me to have a look at, then just let me know. Thank you. What else? I'm based, for those of you who don't know me, I recognize some of the names, but for those of you who don't know me, I'm based in the City of London. I am a multi-account trader for high net worth clients. I also trade my own capital. I'm a technical trader. And a trend trader. So really, I focus on markets which have really strong trends, where the probabilities that the market move is going to keep going is much higher than kind of unpredictable markets that tend to go sideways. And yes, so we'll have a look at what's going on in the various markets as well. There've been some amazing moves today because, of course, everyone is, all the markets are watching the US dollar and rates of inflation and trying to calculate and price in what future rate hikes are going to happen in order to curb inflation. So on the agenda, we're going to talk about identifying crucial support and resistance levels for the crypto markets, as well as chart analysis for the preferred assets such as Bitcoin, Ethereum, Cardano, and a watch list for traders to consider with strong support and resistance levels. So let's go across to the platform. We'll come back to this at the end. Let's just go across. I'm using the MT4 platform. What I'm going to do very quickly is just clean this up. I have a different layout, which I'm using at the moment, and just switch up the template. Let's go and have a look at this. There we go. So that will do fine for us. And then let's move across and have a look at some of these. So I'll bring up Bitcoin. Is there anyone here who is not familiar with MT4 or MT5? I'm just curious. And also just have a look at what else is on in terms of my options. The problem with, there we go, thank you. We've got Ethereum, Litecoin, what are the other ones? Ripple, Dogecoin. Let's have a look at this as well. Cardano, Solana, and Binance. If we've got it, there we go, that'll do. Cool. So I have, not that anyone should care, but I've got a piece of Ethereum and Bitcoin, and I've been buying bits and pieces over the years. So I have a bit of a portfolio there. And I tend to kind of have a look at the top 6, which I include for now, because they might rotate around. This is a very new industry. It's a baby industry. We're going, well, it's been around 10 to 15 years, depending on which one you look at. But actually, I mean within the bigger picture of, currencies for mankind, it's still in its infancy and still trying to decide what it is. Excuse me. So we need to kind of have a look at it within that basis. So I've got them all down here at the bottom. And that's fantastic. So let's start off with the biggest one. So first of all, let's have a look at Bitcoin in isolation. Let's go to the monthly and get a sense of it here. You can, past it there. There we go. And here we can essentially see, according to the data here, especially if we go to the weekly as well, we really are down at cash against US dollar, but I wanted BTC. That's fine. Let's also have a look at Ethereum, just see how that's going. And I'll open this up into another window. So I have these two here. And again, I want to have a look at the symbols. Let's just go back to this. Just checking that I have them both. There we go. Thank you very much. There we go. That makes way more sense. Okay, so this makes way more sense. All right, and we can go to the monthly and we can just load up all that data. Now, if you are interested, you'll notice that I have support resistance levels that are automatically drawn in. It's a tool that I used, which is known as Fractal Support Resistance. It's free, so if you find it, you can download it. Once you download it, you just have to drop it into, you go into the data folder here, and you'll see that there is an MQL5, and you put it under the indicators there. So this is being recorded, by the way, so if you you should be able to get access to a copy of the recording as well. Anyway, once you put it in there, you can either restart the application or you can right mouse click here and say refresh, and then it'll show up listed there. You can just drag and drop it onto the chart, and then you can see what those options are. It does its own thing. So you just set the colors and it'll go ahead and just load up those instruments. See if I've just copied it up. Okay, good. I've also added a countdown in case anyone cares about that. I can see when the candle closes down. Makes more sense if you're on like a 4 hour, then you can see this current candle will close in 2 hours, 49 minutes and 30 seconds. And it makes sense if you are trading, day trading as well. It makes a lot more sense. It's not that useful if you're doing anything about that, but it's there for day trading purposes. And also I have a MACD and an RSI. These are very, very reliable indicators of the strength of a trend. So I can use them to do three things. One, help me confirm that the trend is still strong. So it will help at least get me as much of a green light to join a trend as I can get from the other signals, but it'll be an additional green flag or tick in the box. Two, prevent me from getting into a trend that is running out of steam, that is potentially going to just change direction or go into a consolidation. Or three, alert me to new trends that are going to start, potentially going to start. So what do I mean by that? All of this will come together when we look at the charts. But for example, if you have an uptrend trending higher, obviously there's a possibility in the future there might be a downtrend. So if what I want to do ideally is get to a point where if there's a way to identify the first opportunity of a new downtrend would be great. And I can use these indicators to help me do that. So let's have a look at the major markets. Let's go back up to that monthly, please. So in previous webinars that I've hosted, we were looking at this essentially as a range because this is largely range-bound behavior. It went up to this high, down to this low, back up, and pretty much at the same price, close enough within that area, came back down to this region and then also started to head up, which is generally range-like behavior. However, and this is quite unusual, it broke outside of that range almost immediately. So you get a minimum usually of about 3 or 4 touches before it breaks out. It broke out almost immediately. A big chunk of this, and you can correlate it, is with the equity markets. So the best one to do is NASDAQ. So that will be your most correlated index because it's a tech market as well. And also that that a lot of the institutes in the US have been offering cryptos in their portfolio to their clients who are looking for diversification. Okay, so there are lots of reasons why, but we can see the most recent decline in the tech stocks has also impacted cryptos. Okay, so there's a very high correlation. Has not always been the case because, first of all, prior to this big move up here, most institutions were not interested, were not taking crypto seriously. Then it starts to become sort of mass consciousness, and then institutions start to think, should we start adding this into us? So they become part of the pool of money. They start to influence the moves in the crypto markets. This is kind of, it's very dangerous. I've seen a lot of, I don't know if you get this, but I have, I feel like I have fairly respectable, on my Twitter feed, I have fairly respectable connections, sort of, the people that I follow. And so most of the content they produce should be analytical and well thought out and evidence-based. But once in a blue moon, especially in the last month or two, I get a splurge of Bitcoin is about to have the mother of all bull runs, blah, 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 stuff along that line. And you cannot say that. First of all, I can tell you that it's currently in a downtrend and that trend is either still strong and therefore it can keep going, or I can tell you it's starting to lose strength and it looks like it might potentially change direction. I can tell you when it's changed direction, and I can tell you, for example, when it's a nice uptrend and where it's likely to go next. But what I can't do is when it's in a downtrend, nobody can do this, is say, oh, it's going to turn into an uptrend now without any signs of weakness. If there's no evidence to support that, it is barbaric to turn around and say, oh no, it's due the mother of all blah blah blah. I mean, you can't say that. It's ridiculous to think like that. And I feel like when people do that, it seems to me that they're rinsing. They're either or trying to offload their position or trying to do something. But that you cannot when the market's going one way, tell you it's about to go the other way. It doesn't work that way. Much healthier to say, look, this is the current condition. It's looking good. So it is currently in a downtrend. All right. It is coming into the old highs. These are significant levels here. So you can see here where, at least most recently, the market tried to push through those. It ultimately broke out and continued to the upside. If you really want to be a stickler for it, you could sort of add another level here, which is close enough to where we sort of have been in the past. And you could say, okay, look, price might respect this as a level. So it's currently in a downtrend. If we go down to the weekly and we have a look at it, and I'm just going to widen this up so that we can get a sense of that. And I'm going to have a quick drink of water. We still have a downtrend. What do I mean by that? If we're looking here, I can still see lower highs and lower lows. So this is only, that downtrend is only over when we start to break above this level, certainly when we break above that level. So you have to break the structure. This is what it's called. You have to break above that significantly to say, okay, this portion of the lifespan of this market is finished, because the market goes through uptrends, downtrends, sideways markets. And you need to have a rule that says, okay, when it does this, it's now in an uptrend. Or if it does this, it's now officially or legally, or whichever way you want to put it, but by definition in a downtrend. And currently this is still in a downtrend. It's still producing lower highs and lower lows, but not just that. If you look at the MACD is still trending lower. So it's still doing lower highs and lower lows, the same thing. You can see its wave-like portion, it's still trending lower. So the MACD is bearish, price is bearish. This is a momentum indicator. So the best way, in my somewhat experienced / biased opinion, to read or use the MACD without the histogram, without moving average crossovers, is to, and without oversold and overbought, generally speaking, is to just look at the direction of it. So if it's trending up, it's bullish. If it's trending down, it's bearish. Okay, but it's better when it's doing what price action is doing. So if price is trending up and the MACD is trending up, that is great. That is called convergent. It means that the indicator is bullish, momentum is bullish, price is bullish. Currently, we have price trending lower. It is bearish in its structure. It is in a downtrend on the monthly, a downtrend on the weekly, and the MACD is trending lower. The RSI, which I'm going to change the settings of quickly, one of the things that is almost unique about RSI is that if I can amplify, like turning the volume up or down. If I drop this number to 5, for example, all it does is amplifies the peaks and the troughs. It deepens the troughs, pushes up the peaks. So it doesn't change the shape of it. It doesn't produce dips or highs or lows where there aren't any. It just magnifies. It just makes them more visually obvious. And here, effectively, I can see that this is trending lower. So again, if I take, that kind of high there, we're still getting lower highs. If I take this low here, we're still getting lower lows. So we are still trending lower here. So both of these momentum indicators, which are used as a double confirmation, are both trending lower. Now, you should always, your goal as a trader, ladies and gentlemen, and these skills are transferable to technical investing as well. Your goal is to master price action itself, just the candlesticks. The minimum requirement on any given chart, all right, is support and resistance and price. So if I just go through, let's see if I've got a clean one. This one, no, what's the other one? Ugh. Just get rid of all these things quickly. Show you what a clean chart looks like. Clean chart makes for very clean trading. There we go. So if I look at this from a weekly perspective, what do I see? I see a nice downtrend, lower highs, lower lows. Okay, it's downtrending. The second most important item is, so price action is the first thing, and the second one, and actually it's debatable which order you have them in. I will show you the folder in a moment. I'll repeat that. Is support resistance levels. Now, why do we care about those? Let me explain why. Support resistance levels are based off price. This is an area where both fundamental analysts and fundamental investors and technical traders overlap, because it's always about price. You know, the cryptos, Bitcoin is pretty standard with 20,000, 30,000, 40K, 60K, so on. Gold, $1,800, $1,900, $2,000. So they're these numbers, round numbers, that tend to be the case. And then, of course, it's not always the case with every single instrument, but it's common enough. So this is where fundamental analysts will be saying, look, I think it's overbought at that price, or I think it's underbought at this price, or whatever. They'll look at all kinds of things. But as technical traders, we can actually see where the physical orders that have been realized or loaded into the market start to show up. So we could see here that the market has responded to these levels from both, by the way, from both below, like that, and above. These are the most significant levels that we need to be paying attention to. And so the way we do it is, if price is trending upwards, okay, it goes up, pulls back, that doesn't necessarily mean this is a level. But if price goes up to that same point again and has a second reaction, it now qualifies as a true support or resistance or price level, because twice this is clearly now valid or important to the market at this time. And these levels tend to respond really well to each other. So fundamental traders will use them, technical traders will use them as well. So your purest form of trading as a master trader is, and it's good for juniors and beginner traders and intermediate traders to do this as well, is to look at the chart with nothing on it other than price and identify the levels and look at what price is doing. Because this tells us really where the market's likely to go, right? So if price, the way it works is, generally speaking, if I have a price level and the market breaks through it, it will generally work its way down to that next level. Okay, then when it gets to the next level, it will either reject the level or it will break through and carry on down. And as traders, we make the most, we slice bits out from in between, because we don't know what it's going to do when it gets to the level. So when it's working its way from one level to another, that's where we get those opportunities. So if we just look at what's going on quickly to get a sense of the tech market, okay, we can get a bigger sense of, or at least the bigger picture. Let's look at it from a monthly perspective. The levels that I want to be paying attention to are effectively these kind of highs where we are now, 12,200 odd. Below that, we've got 1107. Okay, the next thing that I want you to kind of, so I'll go back to the original design again to bring this back up, but let's look at this classic version. You'll see in the past, we've had these corrections. We needed them. This area here, this area here is what's known in the US as an election year. So this is when Obama was wrapping up, and this was the election cycle, and this is when they finally decided on who the next president was going to be, and the market then took off. But during this period, the market just waits, was kind of treading water, decided what to do. Then we had COVID, which is this period over here. So there were some other kind of other issues that happened, but effectively this should be March 2020, or was it actually 2020? No, that's right, March 2020. This is COVID. And so the market recovered relatively quick from those and continued to go up. What I would like you to please take note of is the angle at which the market used to go, and then it started to change its angle, became more aggressive, and then started to do this. So the angle is what we call parabolic. The thing with when the markets go parabolic is they tend to have a very aggressive correction. So it becomes aggressive on the way up, expends a lot of energy, dissipates a lot of that, and comes back in line with that original trajectory. That's almost always what happens. Okay, like 9 out of 10 times. So it's fair to consider that might well be a possibility here. Okay, so what I'm doing now, if you think this has nothing to do with cryptos, is I'm making the case for this to be the potential first area for the markets to have corrected. Roughly in line with that kind of original trajectory in towards this area. This is not a bad area for it to come back into. Could go down a little bit further, but there is actually a historical level of support here. And if the market did decide to resume from here, that would be acceptable. If we look at Fibonacci retracements, We've come down into the 50-618 area. That's great. A healthy trend can come back as far as the 618 and continue upwards and still be a very strong trend. Shallow would be a 382, but it's in the 50 to 618 area. I'm happy with that. Let's move it down to the next one. Let's see what it looks like down here. Still puts us at the 50 fib area. Let's go even further, put it down here. Puts us still below the 382. Yeah, it's fine. We are plenty fine on in terms of this being an acceptable correction. And there's a lot of the sky is falling. But my fear is there's a lot of people out there that it's easy to get into an echo chamber, where it's pure garbage, but it sounds like it's organized, well-thinking, data-driven opinions, but it's actually not. It's just someone trying to rationalize their fears, and that often happens, and it happens a lot more today. We have more disinformation on the internet today than we've ever had going through society ever before. There are people who thrive on it. There are businesses who get paid to do it. So it gets very tricky. So the question you had, which was, where is the folder for the indicators? If I go back through this, so you go to the file, open data folder, and then you will always see the MQL5. So this is where all your little tools that are all of these things here on the left-hand side are found within that. If you open that, you will see experts. If you do robots, indicators, or potentially scripts, which are scripts are down here at the bottom. And you will find indicators here. So you just drop it into the indicators folder, either restart the platform or just right click on the refresh button here. Okay. So we are certainly have qualified for the minimal requirements, I believe, for a nice correction to make up for all of this. So it is feasible that we could head up from here. If we're a little bit more fearful about that, then sure, we could, I wouldn't normally do this. I'm not a huge fan of, to me, trend lines should be more just a guide rather than something that I would count on, but just as a guide in terms of giving me a sense of that. And so generally, I would say this would be about potentially the furthest that we could have a correction coming down to that. It's not impossible. I think that it's not impossible, but I think that it would mean that we're halfway through this correction. And I think that we're somewhere in the middle is probably the most reasonable / realistic. We should find that the strongest stocks will probably recover sooner. The weakest ones will recover later, which actually means you could have your strongest ones starting to recover now and your weaker ones potentially still falling a bit. All of those that would actually make sense if there's a lag. And so yes, that would be the case. If this is the case, because you might be wondering what this has to do with cryptos, if this is the case, then we are going to see cryptos largely fall further. And I don't want to be doom and gloom about it. Recession and market corrections and inflation are normal. They are part of the market cycles. They always have been. Every time they happen, it's scary. And sometimes they've been mild and sometimes they've been hard. But every time they've happened, it's always been scary, but they've always happened. We actually have fewer recessions these days than we did in the past, and largely that has to do with QE, which is not a good thing because it means that we're still on the credit card. We're not paying off the debt. In the past, you used to have, it was that, to use an analogy, you'd be spending stuff on the credit card and then you'd pay off the credit card. But we haven't paid off the credit card, whether you live in the UK or whether you live in other countries or the US. They're just spending on the credit card and not paying it off. So this is a bit of an issue. And so that's still potentially a threat. The people who buy Bitcoin range from the true fans of it who understand its purpose as an online digital currency. And if countries and banks didn't think that it was going to exist, or they didn't think it should be taken seriously, first of all, they wouldn't be offering it to their clients, but also they wouldn't be competing by creating central bank digital currencies. So these are things that banks are actually looking to produce themselves. So there's definitely a market for it. They might just simply see Bitcoin as a competitor. And actually, one of the things that I have done is I've underestimated how far any government would go to lose control of the economy, to give it up to that if it can't go through the banks and it can't, if there isn't some kind of control over it. However, I think that these should be viewed as an alternative investment and not necessarily something per se that has to be regulated. But so my point is that there's a lot of different reasons why cryptos can do their own thing, but currently, right now, at this point in time, they are not a hedge against inflation. They are not an alternative investment per se. They're part of the same pool of investments as other equities are, and we can see it because it's happening. We can see right here, we can compare it to other stocks. It's doing exactly the same thing. So its behavior is identical, which implies that it must be that the money going in and out is the same. So it's currently in a downtrend. What I wanted to look at was any signs of that kind of taking a bit of a breather. So if we go here and we have a look at, this, there's a little bit of bullish divergence, which is a little bit of sign of hope. So we have a lower low here, but we have a higher low here, a little bit higher low or a flatter low. This hasn't really changed much. So there's no, I wouldn't say that's a good enough, significant enough expression of bullishness coming in. So I'm not really convinced that that is there. Let's just soften this a little bit like that. Not really convinced that we're seeing enough divergence here. So let me just explain it. So for example, we have principally here, we've got high lows going in, and that's effectively what we have here. So the indicators are doing what price is doing, which means there's no real divergence. In fact, the safest thing to do, and keeping in mind, by the way, that I have money in this, so I want to see it recover just as much as anyone, but I also have to, I can't lie to myself and say, well, it doesn't, I'm not looking for hope, I'm looking for accuracy. I do believe in principle at some point it's going to come back. The question is, will it come back in the next 2 months or the next year? Which one of those is it going to be? And so if you look at this, possibly from a technical trading perspective, even if we weren't looking at Bitcoin, we were looking at euro, dollar, we were looking at gold, this would actually normally be treated as as a bear flag. So this would actually be seen as a bear flag, even though it is technically in an uptrend, producing high lows, high highs. Without that bullish divergence or anything, this is not. Should be treated as a bear flag, which means it should be expected potentially that this could break through here. If it breaks through that trend line, it's likely to do another leg down, which would mean it would come down to these sorts of levels if it did do that. And again, I've always got that one eye, not just on the tech market as well, but also on the S&P 500. So I'll pick the S&P 500 over the Dow 30 because it's simply a larger sample size. It's 500 companies instead of 30. So I just want to get a broader sense of the global economy. So why do I say global economy? It's 500 companies. It's the brands you know and love or hate. It's the Nike and the Starbucks and the McDonald's and so on and so forth. So there's some bullish divergence. Again, this one is very, very similar in its behavior here. It's a marginally higher low, but not over here, not at all. So that's a little bit flat. So I'm looking for that. We do appear to have slowed down. And so this is a possibility. I would need to see us really to kind of feel that we are shifting out of that. I need to see us break above this structure. Okay, so that's a weekly low. So here's your weekly trend. I want to see us break above the weekly. So the weekly is almost more powerful in terms of it will give you that extra confirmation. It's frustrating because it requires patience to watch the weekly, but it gives you the levels. It's more about the levels that it gives you, that those are quite significant. And in the past, when we've had bull markets and bear markets, it's been the weekly that gives us that little bit. So has anyone who here tonight, I recognize some of the names, but who here have I walked you through what we need to see on the S&P to know that we're going back into the bull market, or let's call it who else have I spoken to? Can anyone else? I'll do it again anyway. I just didn't want to kind of bore you. So there's like 5 things that we want to see that will tell me that we've started to recover. So I'm going back here to to some of the kind of biggest crises we've ever had, which is actually prior to this, which was the global financial crisis. Here you can see this was during that during that final election year. And so there's a couple of things I want you to have a look at here. First of all, you will see historically, if you look at the 50 moving average, you will see that for the most part, when you have a nice bull market, it is generally above the 50 moving average. Occasionally, it'll have a bit of a correction, come back to it. Okay, we can see at this point, it moved underneath the 50 moving average and actually tried to get back over it and actually couldn't get back over it. Came back down, and then ultimately got back up above it and then was back into that bull run. So the 50 moving average, broadly speaking, is a great way to underscore whether we're in a bull market or bear market. If we're operating for the most part underneath the weekly 50 moving average, we are generally, I think it's safe to say we're generally in a bear market. So it's when we get back up above it that we should now have, because it doesn't happen overnight. We didn't get to where we are now by accident. We've actually had most of the last year, or it's certainly since January, has been leading to where we are now. People have been talking about the markets topping out and breaking through certain levels. But there's always this kind of funny thing at the end where you get, the market is still in an uptrend, but the difference is in the beginning here, it's doing big moves. It's kind of aggressive. And then it gets to a point where it's now not really doing the moves. It's sort of still going up, but it's not really, but it's not in a downtrend. And this period can last a long time. It can go for 6, 7, 8 months. So it's happening so slowly that people aren't registering that it's changing. And it's the same the other way around. When it turns around and heads up and then you get back into that period can be 6 months. So we use the weekly chart to give us that extra bit of confirmation. So the next thing I want to talk about is what happens here at the bottom. Okay, please take notes, because all of these things you want to see in cryptos. You'll see them in the cryptos and you'll see them in the S&P. If you see them in both markets, it's a great sign. So first of all, when we head down, we start to see these really strong rejection candles, very nice, very green candles. And by the way, I should add here that when the market is at its highs up here, usually the market is at its most buoyant. The sentiment is the happiest, the most, like the greediest, the most life can't get any better than this, or life can't, it'll never crash kind of idea. That's often what happens. And when it gets to periods like this at the bottom, it's usually at its absolute worst. This is like, we haven't even seen the end yet. It's terrible, blah, blah, blah. It's never gonna get better. We're never gonna recover. And the market starts to recover. So it's usually only when you get back up above the 50 that the media, which the media sort of represents the mass kind of thinking most of the time, starts to go, okay, all right, fine, maybe we're not, the markets have broken to new highs, but I don't know how that's possible because, things are still terrible. So we're still waiting for the other shoe to drop. So these are the kind of things I'm going to be looking for. So we need price back up above that 50 moving average. That will be the first kind of clue. And also what I want to talk about here is we had a really nice rejection here, a bit of a double bottom. So on the daily, this rejection here and this one here, whether it is a lower, that's a higher low, or we get a slightly lower one like this, or we get a double bottom, that kind of a look and feel. All right, so we got a bit of a bounce there. We then got a second one. Okay, so the second one was the same thing here again, beautiful tweezers, also a double bottom. This is on the weekly, but if you went to the daily, it was a double bottom on the daily. And then actually we started to break above these highs. So when we go from a downtrend into an uptrend, we need to break above that and carry on up. So that's what we did here. And price went over the 50 moving average. So there's a whole lot of things that happen. We've got of the 5 things that we look at, it's price going back up above the 50 moving average. It's price producing these rejection candles that you see over here. We need to see the double bottom. We need to see it there. We need to see a move back up above, breaking above the highs. And then we also need to see a high low, which you could argue is these two things here. We've got a higher low there, but also another move up there. It's a double, it's like a double bounce, but it carried on. And so we had a higher low, and when it broke above that, we were definitely on our way. So all these things occurred in the past in all the different markets. We need to see that. So let's go and see where we are right now. Let's have a look at where the market is right now. So right now we are far below the 50 period moving average. So we're definitely not back in the bull run, obviously not. We're still on a downtrend here. But what are the different ways in which this could play out? Well, first of all, we could have the market come down and tap this again, come up, break that. While all of that is happening, the 50 moving average will be coming down. So it's not like we have to go all the way up here to get out of it. It'll come down to meet us, possibly even somewhere like that. We could then have a move up and a higher low and break up at that point. 50 moving average crosses over. Now, if I have illustrated this correctly, and this is, let's call this the not best case scenario, but a fair case example, that means that we would only get excuse me, this is getting to normal mode, means that we would only see that in October. If I've drawn that kind of roughly correctly, we would only get there in about October. That's not unrealistic. I'd be surprised if we recovered faster. We had a really big recovery here, but that's probably because the market overreacted. So the market recovered very quickly. But this is not an overreaction per se. So I think that it's fair to say that we would have to see all of this unfold between now and October. And actually that means that we could get a lower low, but then it comes up and does that. So all of this could still be the same, but I want to see if we get a higher low or a lower low, or we bounce off this level. Okay, we could come down to there, we could come down to there, it's possible. But we are still on a downtrend, therefore you have, as a trader, you should be selling and not buying. As a trader, let's distinguish the difference, guys and girls, ladies and gents. As a trader, you're still selling. As an investor, you're making a decision, because as an investor, the best time, if you have the testicular fortitude for it, is to be buying really when the market's going down. That's really when you want to be doing it. You never want to sell, so you either hold or you buy when the market's crashing, but you never sell, because statistically, and that's not just me, that's Buffett, that's Peter Lynch, that's everyone. The market will recover. So if it's dropping, you want to be buying. And you always, when you buy as an investor, this is more discourse. I'm not your financial advisor. You need to get professional, specific, tailored advice if that's what you're looking for you. But as a general approach for me, I accept that if I decided to buy into Bitcoin or cryptos now, that it could still go a little bit further. So my approach is then, I'm fine, because when it recovers, I'll be okay with that. I might also say, listen, let's just say I've got $2,000 now. I might put in $1,000 now, then 500, and then 500, then maybe have a bit more put aside. I can put another $1,000 into it there. So in other words, I understand that it's only on its way up when it's on its way up. So that is something. Let's compare that. Let's go look at Bitcoin and let's have a look at that. So currently, Bitcoin is the sort of granddaddy of all the cryptocurrencies. Let's go to the weekly and have a look at it. It is still in a downtrend, obviously, and on the daily, okay, we've got a bit of an uptrend, but the weekly and monthly are still in a downtrend, and so are the equity markets. So my 50-period moving average is over there, and this is the previous high. So it's a big move, but the market would either have to produce a higher low here, or it has to break up above that and do that. Those are kind of your two areas that it has to do that. And I think it only really gains significance when it is broken above that. And by that time, 50-period moving average will do that. So they'll probably happen all within a week or two of each other. And I'm not really seeing much here. I'm also see a bearish momentum here, which means right now there's no signs of the market tiring on its way down just yet. Doesn't mean it can't stay where it is. It could do that. And then we would start to see this potentially get bullish, and then we could see the market break up. So just because the downtrend is healthy, all of this doesn't mean it has to go down, but it's saying right now that I should not be bullish at this time. There's just not enough evidence to support it. And as I said, and I stand by this, actually, this trend line, which I put in, which can be seen as a level of support, should be treated as a bear flag. So if you trade trends, one way that some people do it is, as the trend is pulling back, you continually put a trend line in that, and when it breaks, that means it's a continuation to the downside. So that's what's happening here, and that would be what's happened there, and this one is a breakdown, so on and so forth. And right now, there's just more that says that this has still got some potential. I've got to see it. Again, I'd also, want to see it go back up above the 50, even on the daily. That's a broad strokes. That means that if you're confused and you need to take a step back and go, okay, where are we? If it's not above the 50, then it's not really enough. It hasn't shifted enough momentum yet. So that just tells me that we've got time before we do that. And do I see it as a trap? I mean, to go back to the title of this presentation, I don't believe in traps. I don't think that that's the right idea. I don't think the markets are manipulated today on a mass thing. When we trade with the trend, we're trading with the big money. So we're doing what they're doing. It's when we try to get clever and try to anticipate what we think they're doing, and we start to read conspiracy theories, we get all kinds of funny thoughts in our head. Currently, there is just, remember that the chart will show you when it has started to, when those actual physical orders have started to come in. The chart is the printing of actual positions. And it will show you as it breaks levels and as it goes above the moving average, and as it does that, the candlesticks will change from largely red bearish candlesticks to more green bullish candlesticks. And it cannot hide that. It's impossible for it to hide that. Those are actual orders that are coming in. And as traders, we follow the collective behavior, not a single candlestick per se, but the collective behavior. And the collective behavior right now is saying we're in a consolidation period, and we will either bottom out or carry on down. And one of the things that could happen, for example, is it stays above that trend line, breaks down, taps the same level, and then has a rejection, and then you get that kind of bullish divergence. And that would qualify, as I said, that would then qualify as a shift. But at some point here, I think it's fair and realistic to expect the market to possibly push a little bit lower. Now, some of you may or may not be aware that we've had the dollar has been absolutely insane at the moment. So if we go and now we look at the currency markets, because the dollar matters. The dollar right now is pretty crazy. It's just very, very strong. So if we look at where this has been on a monthly basis and where these major levels are, we've been stuck in a range for many, many years. Okay, we've fallen right through that. We've tapped parity today. If we go back, how much history have we got here? Okay, so we can go all the way back. Wow, we have all the history. That is amazing, guys. We have all the history of the currency markets. And also, just to give you some perspective, the currency markets were not available to us as retailers until like here. Pretty much 97 or something, 96. Prior to that, it was interbanks, big institutions for the most part. Currency trading is a baby as well. And cryptos have only been going sort of 11, 12 years and only really actively used in the public in the last 6 years or so. So to give you some perspective on that. Okay, so prior to, forget about that, but really prior to that, we've had the dollar, the euro below parity, just like for a short period of time. It's been above it a couple of times and just broken. So we've broken below this level, which when you think about it is historically significant. Okay, I think it's historically significant. We can rebound from it. We will have to see where these particular levels lie. We could have that happen. And we could see a bit of a bounce back from it. But also at the same time, I'm trying to talk here about how, because we've broken out of this range that we have been in since 2014, 2015, and we've broken parity, which we haven't done since 2002, we are possibly in a new phase of market behavior, that something has changed. If I go to, it's connected. This is not random stuff. The US economy, inflation, rate hikes, which is going to impact every country, has changed people's thoughts about investment. They're pulling the money out of stocks, out of crypto, panicking big money institutions, so on and so forth. It's much simpler. The cogs are bigger and more simpler and more connected than people make them out to be. People who are obsessed about Bitcoin, I'm not referring to you guys, I'm talking about some of these people on YouTube. They talk about cryptos as though it's an isolated instrument, that the only people who own Bitcoin are the people who use it and no one else, not understanding that big institutions are selling it to their clients. And that's very easy to verify. Just go and look up the big institutions, look at some of the banks, some of the big brokers. They're talking market share. So let's look at dollar yen. So dollar yen, which also can often show its head during times of crisis, okay, has broken out of its range, excuse me, very aggressively. Call it in, when was this? I can't see there, but it must be December, January, we saw this thing break out. And actually it's now at levels that it hasn't been in since the 80s. Can you imagine that? We've got so much data here, you can't imagine how amazing that is. So now we're back into areas where it was in the 90s, I guess, in that area. So all I'm saying here is we've got a couple of currencies that have moved into ranges they haven't been in 20 years. We've got them breaking out of ranges that we haven't seen for a while. We've got equities experiencing one of the biggest corrections they've had, but after a period of unusual historic growth. So this is the steepest it's ever been. It's the biggest move it's ever done. This is the most naturally, it's a balanced correction or a proportional correction, which makes up of that. So we're in an area. So I'm saying that, yes, is it possible that we're halfway through? This is the belief by the pessimists, are that we're halfway through this, that we would see that we're only halfway through, that we could see it go further. So in other words, the consequences we've got to now, there's going to be a bit of a knock-on effect that we haven't seen yet, which will then lead to a bit of a contraction and recessions, which will then lead to job cuts, which will then lead to blah, 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 which will then trigger a further decline. So that's, to me, is obviously scary, but it's the worst case scenario. This is where we are now. Can the markets recover? Because there are a lot of countries that are showing strong economic data. Not all the data is bad. Low unemployment, there is growth. Could we have something in the middle? So Ray Dalio talks about stagflation, where you're getting not much growth, but you've also still got high inflation, which is also not great. Okay, so the point is that yes, could we see this at the moment? And again, we're doing these webinars every week. So as it unfolds, you will get analysis literally within a few days of the market. Definitely it is now starting to change direction. You'll start to get a sense of that. But I don't believe cryptos are in a trap. I don't think so. I think that we are near the bottom of their movements. But I also know that I need to start to see them break up, get above that 50. Certainly on the weekly, I want to see a shift to the upside before I start to go, okay, we're now starting to work our way out of it. And if I see that happening on equities as well, then I know the broader picture is we're starting to see that happen. Okay, there's a lot of doom and gloom out there. And to kind of illustrate that from experience, I remember when, excuse me, I remember when gold was on its way up here. So this is where I was learning how to trade the early, oh, holy cow, that's not right. Monthly, here we go, I meant here. So I was probably learning how to trade about here and was sort of starting to trade gold at this point, and it just went up like this. And at this point, YouTube wasn't really a thing in the same way, but there were people saying you've got to buy this PDF, my special PDF, and why there's going to be a complete panic and it's going to be chaos and the end of the world is coming, and you have to buy this and get guns and buy gold and silver because everyone's going to go crazy. Most people don't even know about this today. Anyone who came into the markets after that period has no idea that this was how crazy things were back then. And that's not long, that's 2011. And then it came down, couldn't get back up, couldn't get back up, couldn't get back up, then broke through there. Once it broke through there, it stuck here so you can see from 2011, it finally broke out in 2019. That's like almost 8 years of it doing nothing. And during this time, you didn't hear a chirp out of anyone who spoke about how it was going to be Armageddon and you had to get all that stuff. So I guess what I'm saying here is that I would take the Armageddon stuff with a pinch of salt and at the same time say, what do I need to see in the markets to know if that's going to happen? But don't let it make you panic. For the most part, most governments would do almost anything to avoid that, and therefore it won't happen. The difference here is it's not like everyone's not paying attention to the Titanic. We know there's stuff we have to do, and people are doing it. So I'm trying not to be an alarmist here, but I feel like I'm potentially sounding like it. I'm not. I'm saying we're in a very fair place where we might be able to stabilize and then start to recover and then go back up. There's a lot of data that shows that many economies have lots of great stuff in them, lots of good data that's happening. We have some inflation, which is directly tied to COVID and to the Russia-Ukraine war, directly tied to those. So if those weren't around, would we still have the same, would the problem still be as bad? And that's what we need to know the answer to. So once those things are resolved, whenever that may be, it is very likely that we would see 80% of the causes of whatever the environmental pressures are that we're in right now go away. So we just have to stay calm. Staying calm is the way to kind of just see your way through it. And I stand by that. Any questions, by the way? I'm just, because I realize I'm talking a lot and wanted to see. So there is a question here saying, how do you recognize a bull trap versus bear market correction from a potential bounce into a bull market back? Okay, so that's a long question, and let me just see if I understand you correctly. So for example, this is an uptrend, and yet I'm saying it looks very much as though it's potentially a bear flag before it breaks down. So I'm only doing that because, yes, we would see a change in that, but mainly because I'm not seeing any bullish divergence here. So that means this trend is not getting tired. It's still pretty much going at its own pace. This behavior here as well, a change in trend should have resulted in a move like this. So in other words, it should have broken above here to come back and test it. It hasn't done that. So it's a bit deceptive because it looks like it's slightly bullish, but it's not really. It's not. And I'm also, again, remember that I'm looking at the equities markets at the same time. I'm not seeing anything different over there. So, but let's go do that. Let's go see what's going on, for example, with the S&P. Let's go to the daily. You can see here the market is desperately trying to stay above this level. Okay, it's trying. It's really doing that. And I would say that one difference is that I do think there is some bullish divergence that's starting to creep in here. So there's a higher low there. This one looks the same, but for whatever reason on my platform, I had more bullishness on both of those. So I do think there is a possibility here that the market did a big move down, tried a deeper pullback, did a smaller move down. So now the distance from this low to this low is less than that, and it's back up again. And now it's trying not to go down again. Doesn't mean it won't succeed in going up. It could fail and keep going down again. But this is the first time I've seen here since over here that the market was trying to slow down. So at some point that slowing down is going to be the final one. That's going to be it. If we look at it from a weekly basis, we've got a really nice, this is a beautiful rejection. That's like a U-turn. If I saw another one of those, we'd have a nice little double bottom or a higher one, and break above that, we'd start to work our way back up. So right now I have to presume that anything that looks bullish just for now is not enough to necessarily change the markets. It could be the earlier signs of it, but it's not the final signs of it. That's, I think, the important thing. Right, and again, yeah, if we start to break above here, but again, if we break above this, then that's a clear sign. It's always about kind of price levels. There's got to be a level that if it breaks, you're like, okay, that's good, because it took effort to break through that level. Here's the daily one, here's the weekly one. A break above this is a good start. But when it gets above that, then you kind of know, and that might seem like a long way or near the top, but it's not really. Breaking above there and breaking above there would be a good way to do it. You'd be back to where we were in 2021. Yeah, so again, let's just have a look at this at gold as well. So for example, let's talk again about those kind of ridiculous ideas. This feeling that gold is a safe haven thing. It's not. I mean, there's no signs of anyone buying gold at this point in time. However, if we did have something crazy happen, yes, it's possible we could see a big buy in gold. What we're not seeing at this time, ladies and gents, is any of the big money is not at this time, and they can be stupid, they can be slow, they can sometimes they can be reluctant to admit that the market is turning over. So yes, we could see some of the institutions at this time are not buying gold, and that could happen. The first clue would be either a small nice green bar in this area or potentially a big green bar. That would be the first clue. But if that happened, then you'd have to see at the same time, you'd have to see the other markets drop, because then it's panic, right? Then it's fear. So you see stocks drop and gold go up, because then it's a safe haven thing. And we have to see also correlated move in the US dollar. So and dollar yen, because those are what are known as the traditional safe haven things. But we're not seeing it at the moment. We're just not. So it isn't there. And it's not a secret. It's not like it's happening there. We're not seeing it. This is the worldwide exchange of gold. No one's buying gold. They're selling it, which just means we're not seeing gold as an inflation hedge at this time. There could be lots of reasons for it. It could be that the big institutions think that if we're just patient, within 3 months, life can go back to the way it was, that the problems won't get any worse. Maybe they will get worse, and then we'll see gold suddenly becomes an option. That can happen. However, I would like to think, to wrap up, I would like to think that the strong stuff in our economy, some of the stronger data, is the thing that's going to see us through. And hopefully if we can get a resolution with the war and COVID, then we would be able to work our way through it. So the strong stuff would see us through. And right now it's really going to be about reducing spending and try to curb that inflation. One more thing I was going to say is that if you're not aware of this, there are some increase in cases, in COVID cases and new strains. So just be aware of that, please. Increase in deaths, not just infections, but deaths. So please be aware of that. As much as I hate to be putting the mask back on again, I see the numbers are starting to climb a lot in the UK. So please just if you haven't been paying attention, just go and have a look on the web and see what you can find out. Have a look at the UK COVID cases and just see that potentially we might have to be a bit more cautious on that. Okay, so that's it, I think. So again, I'm not convinced at this point. I think that it potentially, let's see it as a bounce. I do think it's near the bottom. And again, my eye is mostly on equities because the correlation is so high. If equities, and so what would I need to see in equities? I need to see a green monthly candle as the earliest kind of bullish on. You see here, you get a pullback, green candle, and it carries on. You get a pullback here, green candle, carries on, pullback, green candle, carries on, pullback, green candle, carries on. So I need a green monthly candle. We've had one here that wasn't the one. Clearly, I think the next one here could potentially be that one. So it's going to be either July or August, possibly, where we get that nice green candle, and then a break above the high of that would likely see a move. And by that time, that would be the daily would start to change trend, might even start to show up in the weekly. So we are talking minimum 6 to 8 weeks to see a bit of a bottom, at least at the earliest that it could turn around. Okay, so ladies and gents, on that note, stay the course. Life is going to get interesting, but we may very well be near the bottom of it. And likely to eventually start working our way out of it. And hopefully we do. And hopefully by the end of the year, this is all in the rearview mirror. I hope so. Ladies and gents, thank you very much. I always appreciate your time. I do hope you found this instructive and useful. And I look forward to seeing you in future webinars. If you either get myself or Tamar, who is an outstanding trader. Everybody who trade with precision are real traders. You can't join the company unless you've been trading successfully for a while. And she's outstanding. So if whoever you get, by the way, should work very well for you, whether it's Chloe or Tamara, myself, or anyone. And I hope you enjoyed it and found it useful. As I said, there is a recording made available, but on the off chance that there isn't, that you haven't received it for whatever reason, if you just send an email to adam@tradewithprecision, I will send you the link for the recording tomorrow. So there we go. Okay. And that's it, ladies and gents. Thank you very much. Adam@tradewithprecision.com. And I will see you in future webinars. So thank you very much. Have a good evening. Take care.